We're joined today by Meb Faber. Meb needs no introduction if you're watching this call, but Meb is the co-founder and chief investment officer of Cambria Investment Management. Meb, good to see you again as always.
Hello, my friend. Great to see you.
All right, we are going to have fun today talking about what I would describe. When I saw this, I don't know, the news dropped 3 weeks ago. Woo, is this like a better liquid, more diversified exchange fund for concentrated or appreciated individual securities? Is that what we're looking at here? Is that what we're going to be talking about today, Meb?
It's like the 7-minute abs of exchange funds. Yeah,
I love it.
People hate taxes. Who knew? But you know, we often talk about on our respective shows all the time investments and what's going on in the world. But you know, the boring old topic of fees and taxes, we think can actually make a greater impact than just about any other alpha you can generate. And so this is a fun one for sure.
We don't know where stocks are going or bonds or any asset class for that matter, but we do know that when you sell security with gains, the IRS comes for you. Always does. So, all right. So we're talking today about what's called the 351 ETF exchange. My first question is, when I saw this and when every other advisor saw this, we said, okay, got it, see it, I understand. This is a brilliant idea. Why now? Was it some sort of regulatory change that paved the way for this? Like, surely somebody had thought of this back in the day. Why are we just seeing this now?
So a couple things. And for the listeners, you know, most of you probably are familiar with the 1031 exchange. You know, when you think of real estate transactions and all the people that have built generational wealth who bought a building and then buy a separate hotel or a different property, and then that not being a taxable transaction, the famous 1031, that's been in the tax code forever. The 351 actually dates back to the 1930s. And you can hear our good buddies, Wes at ETF Architect, who we're partnering on this with, get really into a lot of the details about the history of it, which is pretty fun. But originally, a lot of the ideas were for people forming a company together, and if you're contributing certain equipment or certain, you know, a tractor combine or something. But really, as you roll forward, you have a lot of these ideas really start to accelerate. So the exchange fund you mentioned, which has been around since the 1970s, 351, particularly when reference to investment strategies and funds, Bob Elwood, the partner lawyer we're using on this, did one 10 years ago. And since then, depending on who you ask, there's certainly been over 100. Now, some people, they say over 400. I think that number's too high. But the reason you haven't heard that much about it is traditionally, you know, it's something like one fund to ETF. You know, you've seen all these mutual fund ETF conversions. DFA did 50 billion. I think there's 100 billion total last year. So there's actually a lot of prior art. But almost always it's one fund or one very specific group into an ETF. And innovation we're trying to bring to the market is, hey, let's make this available for everyone. Let's make this open enrollment, whereas anyone can come and say, hey, I want to contribute to seed an ETF launch, be able to contribute a portfolio and it not be a taxable transaction.
So before we get to all of we look under the hood of the 351 ETF exchange, what we're talking about here, to not bury the lead, is individual investors hold individual securities, whether it's Microsoft or SPY or whatever, and it's a bull market, and it's been a bull market for a long time. And they might have concentration issues that they are exposing themselves to because they are fine taking the risk because they don't want the certainty of the tax bill cometh. So before we get to the details of seeding the 351 ETF, the exchange fund had been the solution of choice for investors via advisors to exchange concentrated positions for a diversified portfolio. We've looked at exchange funds. There was all sorts of, let's say, suboptimal solutions. Talk about why the exchange fund wasn't quite cutting it for advisors and their investors.
Yeah, I mean, look, you got a couple of choices. You got a bunch of money. I guess our parents' generation would have been GE or IBM. You know, maybe you got a bunch of Amazon or Microsoft, as you mentioned. For you, maybe GameStop. And your concentrator's stuck. And so how many people have you heard, I can't sell this because the tax man is going to kill me? And usually that resolves a couple different ways. One, they eventually just sell it and bite the bullet. Two, the stock goes down 80%, so it solves the capital gains problem. Well, you see it affect behavior. I mean, think about Buffett in the late 90s. Would he have sold Coke if it wasn't, paying taxable gains on it when it got to be very expensive? Like maybe. And so the exchange fund's really been around since the 70s. It's been around before that, but since the 70s, it really started to get marketed. Eaton Vance, Goldman Sachs, Merrill Lynch. And basically the way that one worked is you would contribute something. So let's say you got 10 million of GE. You contribute it to this fund with a bunch of your buddies, your golf buddies, your friends. You had to be accredited or qualified. And you got 100 people, they put in all their various stocks. And so you get a portfolio in return. Now, there's a couple other rules. You had to hold it for 7 years minimum. And of course, for that privilege, Goldman's going to ding you for probably 1.5% per year. They'll probably charge you 2% to set up the fund. And then you end up with whatever this amalgamated portfolio is, and they'll distribute this portfolio at the end of 7 years. There's other problems, like if somebody wanted to sell in the interim of that 7 years, it may cause you to have gains. So it's a solution, but it was never a great solution. It certainly wasn't a solution that was offered to the masses. And so a lot of people get stuck with these concentrated positions, which often cases, as you know, it can work out, but also it can be a lot of downside as well.
So the modern version, the 351, which is a section of the tax code that allows you to do this, you are partnering, as you mentioned, with ETF Architect, the good folks there, to allow investors to seed the ETF with individual securities. Talk about what this process looks like before maybe we get into the fund and what you're investing in. How does this actually work?
Yeah, and if you want to get super nerdy and wonky, listeners, you can. We did a podcast in February this year on my show, Meb Faber's show. It's 522, and this is like 501 level nerdery. But we did this podcast with Wes, and they did a 351 for an asset manager who had 5,000 accounts, and it's crazy to think about it. I know Batnick and Carlson got these Excel sheets that have 5,000 tabs. But can you imagine trying to herd cats of 5,000 investors and all their different portfolios? It's pretty complicated. But these are a bunch of former Marines, so I feel comfortable with their efficiency. But really, the concept is, all right, there's two main rules when you're going to do a 351. The first is, you can't just put in all Batnick's GameStop. It's got to be a somewhat diversified portfolio, meaning the top holding can't be over a 25% weight. So you got 10 million in NVIDIA. That means you got to have another 30 million of something else. Or the second rule, part two, is anything that's over 5% can't be over 50%. So said differently, listeners, you basically need 11 stocks. What's nice about this also is that ETFs are pass-through. So you could actually contribute 100% SPY, because if you look through SPY, you can see all the holdings are diversified. But on average, it has to be a somewhat diversified portfolio. And so the whole process for us was, we're actually filed 3 of these. The first one's coming out in December, the next one another 3 months, the next one another 3 months. So people can kind of look at the menu, pick and choose from the different strategies and ideas. They may not want Fund 1, they may want Fund 3, but October for us was all about education. November was like, hey, let's get down to business, get people qualified, understand that their portfolios are okay or not, and then launching in mid-December 18th for the fund. And that's kind of the process. We can get into much more specifics if you want, but that's the two main rules: stocks, ETFs. People love asking if these other 90 type of strategies or investments they can contribute. Bitcoin, no. Dogecoin, no. Hedge fund, no. Mutual fund, no. Futures, no. Options, no. Really, mainly it's just stocks and ETFs. There are some other use cases, but to keep it simple, those are the two biggies.
All right, so I've got a client, let's say, that has 20 stocks from back in the day, and there's a lot of gains there. I want to exchange these 20 stocks for your 50 stocks or whatever is inside the ETF, which we'll get into. How do I do that? Is that a form? Is it DocuSign? Is it paperwork? At which, is it available to all the custodians? How does that work? Because very importantly to mention is that when you do this conversion, the tax gain doesn't disappear, but it's not a tax arbitrage. It's a diversity arbitrage, like immediate, real diversification. So how does the tax man know before we get into this fund how we're seeding it?
Yeah, let's be very clear, listeners. We're not washing or wiping your taxes. It's merely a deferral. and you're getting a diversified portfolio in return. So, but the beauty of the ETF structure is once you're in the ETF, that portfolio can turn over, much like SPY has done in the 90s, and you're not going to be paying traditional capital gains yearly like you would in a mutual fund, separate account, or hedge fund. So the way it works, there's two kind of parallel paths. It's one path if you're an individual who's got an account at Schwab and calls me after this and is like, Meb, I got 10 million bucks, help me walk through this. And it's slightly different if you're an advisor at Ritholtz Wealth Management and you got 10 clients and you want to go through those. But in general, it's not too dissimilar. A couple quick answer questions. The big brokerages are great. Schwab, Fidelity, Interactive Brokers, some of these self-clearing, some of the other brokerages, it's a one-off basis, what qualifies and what doesn't for them, because a lot of them, this is new. Many of them, they love to be very slow and methodical about approving ETFs and things like this. So I think we have one fund approved on Merrill after a decade. So we'll see what they do. But in general, it's you got the main big clearing houses, they're fine. The main positions, they're fine. But let's say it's you, Batnick, and you're like, I got 10 clients, and they're okay on Schwab, they're okay on Fidelity. Then you look through and you say, I've looked at their portfolios, they're good, right? So I'm not giving you all my Dogecoin, whatever. And then it kind of goes, okay, well, what happens next, right? Like, what is the flow of this after that? And there's like 2 or 3 things that need to happen. Wes and team is actually building a pretty fancy software tool. I don't know if it'll be fully done by this first fund launch, but you can type in your portfolio, qualifies it, puts it into the queue, and it's a lot simpler. But in general, you got to confirm the brokerage availability. There's a paperwork package. Basically, it's like a Excel download. You put in your positions, right? It's like, here's my 10 stocks, or download them from Fido or whatever. There's a DocuSign letter that your client's like, okay, I understand what's happening here. And then I think you got to print out like a broker statement or PDF that says, yes, this is the cost basis. And that's about it. I believe there might be 1 or 2 other kind of check the boxes, but.
All right, so it's reasonable. You don't have to jump through hoops.
Yeah, I mean, it's not nothing, but it's, I once transferred, the most alpha I've ever generated in my career was I was transferring a brokerage account either to or from Vanguard. I can't remember which. And it
you
took
got out
like
of Lehman.
4 months. But it was 4 months when I think the market was crashing. So maybe it was 2020. I can't remember. But I think unintentionally, I just missed out randomly for like 4 months of whatever was happening. So this is not that. This should be, I think, quite a bit simpler. And the good news, again, they've done this many times. This is my first time, so it's going to be a little more new for me. But basically, you end up December 17th, your portfolio is contributed December 18th. Or we put a freeze, you say, hey, stop trading December 1. I know you love to trade a lot, but say December 1, stop trading because we want these positions to be fairly static. And granted, who knows, NVIDIA could 10x from there, and then you may have to adjust it. But in general, December 17th, the portfolio gets contributed. To December 18th, you open a brokerage account, and you got the tax ETF in there, and it's got the cost basis of the underlying positions, right? So it's a pretty clean, slick process, but it's not as easy as just hitting buy sell on Robinhood.
So the first ticker symbol is tax. How'd you get that?
Tax, you ask? You got to see what's available.
Okay. Well, the reason why I asked, Meb, is because there was an article in Bloomberg not too I think it was in October, talking about that 4 symbol ETFs are overtaking the 3 symbol ones because there's like squatters and everything that can be 3 tickered ETFs has already been done. But by the way, in that article, they mentioned that in Europe, you're allowed to have numbers in an ETF, which for the leverage stuff makes a lot of sense. Let's get on board. I like that. Do you like that?
Well, it's fun when you look at like foreign securities, Japan, all the tickers are just numbers. So you look at your portfolio sheet, it's like 65832114. It doesn't
like
just say
one.
Toyota.
I'm bullish on that one.
But yeah, look, the way you can reserve them, you have to have the intent of launching these. We got a bunch of prospectuses filed, but it often will surprise me what's available. We got We got Mike for you. Actually, I don't know. Do you think somebody's currently trading with Mike?
I hope not. God.
Anyway.
All right, so let's get back to the. Okay, so we understand the process of how this works. There's a little bit of paperwork. Sounds like it's going to be better streamlined in the future, of course. But I was super excited about this idea, and I got a little bit less excited, but not too much less excited. There's a workaround here. So the original thinking was like, oh my God, we have so many people in this country that are stuck with these monster gains, and they understand that they want to sell them, but they've treated them so well. And like Amazon's not going away. Like Amazon's Amazon. Like, why would I guarantee take a 20% haircut if I don't have to? And I thought that this was a solution where they could whoosh, get out of Amazon and into your strategies or whatever it is. But it doesn't quite work like that because, as you mentioned earlier, there are some rules with these funds. And one of the rules is no single position can be greater than 25% of what you contribute to. So as I'm thinking through this, so in other words, if all you have is $10 million in NVIDIA, well, there's not really much you can do with this. Okay, most people don't just have $10 million in one individual security. So what they can do though, is let's assume that they've got other positions that have generated gains, is you're gonna have new funds launching every 3 months. So maybe you can't do it all in one fell swoop, which would be great. But okay, that's what the rules are. That's regulation. We can't change that. But over time, and there's some work in here, but that's what an advisor's for, right? That's why you hire a financial advisor. Over time, there will be more funds so that you can do this with your NVIDIA or your Amazon or your Walmart or whatever it is. Talk about the actual cans and cannots of what the fund allows.
Yeah, I mean, the big thing that you mentioned, and you can get more creative and start to really think about some ideas here. But in general, it's a big unlock for appreciated portfolios that you may not want anymore, right? I mean, the way that market cap weighting works is whatever goes up the most ends up being the biggest positions, but it's not just market cap weighting, it's any portfolio. If you buy 10 stocks 10 years ago, chances are 10 years later, the top 2 or 3 holdings are going to be almost the entirety of the portfolio, right? Just the way the power laws of markets work. This is a big unlock also, or an off-ramp for direct indexing. This is another strategy where it's very tax efficient for a few years, and then eventually you have a lot of highly appreciated positions, but you also have a lot of highly appreciated positions, right? So there's some really interesting use cases. We've certainly got a lot of inquiries from family offices. They tend to be very tax aware, CPAs, advisors, of course. And again, you mentioned the 25% rule, and you could theoretically roll one position into various funds and be able to eventually get out of that NVIDIA in your example. But to start, yes, you do need a decent chunk of assets in something else. And something else could be SPY, it could be any ETF. But
well, let me ask you this, Meb. So let's say that you've got, okay, NVIDIA is 25% of the stock that you're going to seed the fund with. Does the other 75%, do they need to be, like, what if you're underwater? Do they need to all have big gains?
Well, presumably, if they were underwater, you would sell them, book the loss, then you could just go turn around and buy SPY or Qs or something else and contribute that. I'm not sure why you would want to contribute something. You can contribute
only just to get to the 100%.
What's that?
Only just to get to the 100%. So
yeah, you could, but I mean, more likely the person would sell those, book the loss, buy something else buy an ETF with the.
What if they're waiting to get back to even? You ever think about that?
What if they're what? Oh yeah, exactly.
Okay, so you make a very good point though on the direct indexing side. So we're big proponents over here at RWM of custom indexing. So we're not just buying the S&P 500 because, to your point, you will I don't know how quickly, depends on how good the bull market is, but eventually you will have harvested the losses that you can because you will run out of losers to sell. If you have been a direct indexer in the S&P 500 or another index, whatever, let's say for the last 8 years, and you're sort of stuck, this is a brilliant tool to do something different.
Theoretically, you could also roll this ETF into another 351 exchange one day if you didn't want this one. But I think 3-5 years from now, you're going to see a revolution in tax efficiency. We've started to see look, there's always been academic research about tax efficiency, but historically, it's almost entirely focused on a world in which ETFs don't exist. And you start to think about ideas that are pretty unique. But Wes, again, his box ETF, which is a T-bills type of fund that doesn't pay T-bill income. That's
Genius.
incredible if you're a taxable investor but want T-bills. This type of strategy, and going into our first fund, which is also a tax efficient strategy, the strategy is particularly interesting in the ETF structure. So if you look around the academic literature, it's almost none of it thinks in terms where there's a world of ETFs. And if it does, it fundamentally changes the equation of what you can do and where you should hold it. I mean, historically, people are like, I got a taxable account, I got tax exempt. I'll throw my REITs in the tax exempt because they yield 12%. And that's about it, right? But now that you have these ETF ideas, I think in the next 3 to 5 years, you're going to see a sea change in how investors allocate thinking in terms of taxable and non-taxable.
I love it. Meb, last thing from me. So you mentioned some of the use cases. A couple of weeks ago, Ben and I were doing a podcast, and the Wall Street Journal had interviewed NVIDIA shareholders that have been longtime shareholders. And I was poo-pooing their success a bit, only a sense that, listen, we don't reward lottery winners, right? Like, it's not like, oh, congratulations. Like, what about how all the people that didn't buy NVIDIA and oh, well, they stuck with it through thick and thin. Well, so what? How did they know that the 70% decline in 2022 was they didn't know about AI. Like, so I don't give them credit for that. However, I got an email from a listener and he said, hey, I was actually one of those people interviewed in the story. And what they didn't say was, I have a strategy, and my strategy was to buy all of the new issues, put $5,000 into each new issue, and hold all of them. And the losers would go to zero, and the winners would more than take care of the rest. And I said, okay, all credit to you. You deserve the credit because that's a really sound strategy. And I loved hearing that. So on the off chance that this person is listening to this story and he's got all of these appreciated positions, please call Meb.
Yeah. It sounds like Batnick's a little jealous, listeners. I mean, he's
I can't hold big winners. I don't have the personality. I just doubled my money in Netflix. Thank you. I'm out. I do not have the personality to hold a 10 bagger. Never have, never will.
This is why I'm a quant. And listeners, I will mention in Batnick, because I think this is interesting and important. The first fund we're launching, tax, the strategy is a strategy that for many years we didn't launch because it's arguably the worst marketing strategy ever for
it's a
fund.
bold strategy, Cotton. Launch something that nobody wants. Go ahead.
Right. Well, I mean, in the paper we wrote, it was also a terrible title. Like, thinking back to it, I'm like, who came up with this paper idea? The name of the paper was like, if you pay taxes, don't do this, like do this instead or something. This is like literally the worst title ever for a paper. But listeners, this is a strategy that focuses on stocks that don't pay any dividends. So think about that right there. Like, who wants that? Nobody. Everyone, this entire market of the last 5 years is income, anything that pays these yield type of strategies. And we're saying, no,
you're going against the grain.
Well, we'll see how it does. But theoretically, on an after-tax basis, last thing you want if you live in a high tax state like you do or I do is a bunch of high dividend yields. So we'll see what the reception is.
You know what? I apologize. This would have been a terrible interview if I forgot to ask about the actual strategy. So I just one question. All right, what companies don't pay dividends? Because I know you're probably not owning NVIDIA.
Who's the perfect example is Buffett. Buffett famously for Berkshire, he's like, Berkshire's never going to pay a dividend. It paid one in the 60s. That was his joke. I must have been in the bathroom when they decided to do it. He does buy back a lot of shares. So we did a simulation. We said, look, if you can invest in the S&P with no dividend yield on an after-tax basis, you do better. Like, that's just math. But like, everyone loves even high dividend yield strategies that yield 2, 4, 6, 8, 10%. And historically, could you match the outperformance of a dividend strategy with no dividends, in which case, after tax, you would destroy that strategy because you're not paying that yearly dividend cost. And it turns out you can. And if you just avoid like the top third of the dividend universe, you don't have to avoid all of them. But if you just chop off the long tail of high yielders, that already pushes you down to pretty low. And in the U.S. right now, I mean, the S&P yields 1.3. It's not like, there's a ton of super high yielders. But just by avoiding those and then tilting towards value, So you in general, you tilt towards value, tilt towards buybacks, quality, all that good stuff, put it into one, equal weight it. On an after-tax basis, you end up in a much more warm and fuzzy place than if you had to pay taxes on those big fat yields as well.
Last thing. A lot of the individual securities that advisors hold on behalf of clients and that clients hold on, or that do-it-yourself investors hold on behalf of themselves, are probably growth stocks. And there's probably a large cohort of investors that would say, I would gladly give in my Amazon, my Nvidia, my Google for a diversified portfolio of stocks, but I don't want to do it. I don't want to trade my Nvidia for boring value stocks. I know this is not in your DNA over at Cambria, but have you considered, or would you consider launching something that looks a little bit more like a growth-oriented portfolio?
Couple comments real quick. One, we love talking about our shareholder yield strategies in the U.S. that are very value. These have been running for over a decade. The U.S. fund largely avoids tech stocks, and that's because tech stocks, growthy type of names, on average, are expensive, and they issue a ton of shares in the U.S. Tech stocks is actually the number one sector in our emerging market shareholder yield fund. So value in emerging markets is finding a lot of opportunity in the tech type of growthy names, just not in the U.S. But secondarily, we've had hundreds of conversations the last few weeks, and a lot of time people say, Meb, 100 million of clients, that would be perfect, but you know what? I don't want your harebrained strategy. I want XYZ. And we got three. Second one is a diversified ETF portfolio. Third one is a global shareholder yield. But they say, Meb, can you just give me like equal weight S&P type of something? Or can you give me dogs of the Dow? No one said that, but just theoretically. Can you give me the Batnick strategy? We're open to that. If it's something we can get behind, I'm not going to do one of these dingling strategies that,
It's reasonable. So if they bring the assets, you will come.
If it's reasonable and if it's something that I would put my own money into, then sure. Yeah.
Okay, but at the 25% level, that can't be at the advisor. That can't be at the RA level, right? That's looking through to the individual.
It's per account. And let me give you one more idea. If you're an advisor like y'all, most advisors, financial advisors, this doesn't necessarily apply to. But let's say you're like, oh man, like we have a strategy. We're an asset manager. We've always thought about running a fund. Maybe we're going to do a fund in 2, 3, 4 years. We're just not ready quite yet, but we want to take advantage of this tax efficiency. You can obviously do this 351 conversion, get tax or one of these funds in return. And then theoretically, if you want to run a fund one day, you can just roll this fund into your fund. And because of the look through, it automatically qualifies. It's actually probably a lot easier than doing all your own positions today. So it leaves open a lot of flexibility in tax management that you could do in the future that you may not want to think about today.
Okay. You have my gears turning. Meb, you are the man. Thank you for the innovation. Love to see your success. Thank you for coming on the show today.